protected when options are limited. And we will be recording the session. So if you miss something and you want to watch it later, you will have that opportunity. So we're going to get started. A little bit about United Policyholders. We were founded in 1991 here in California, but we operate nationwide. We're unique. There really isn't any other nonprofit quite like us. We are focused on one product, insurance, and one set of scenarios when you're buying insurance or when you're using insurance. So we're a nonprofit source of information and help. We have expertise in insurance, but we don't sell insurance. You can't hire us or pay us. We're here to give you information that's in your best interests as your advocates. We're supported by donations, grants, and volunteers. We're a respected voice for you, the consumer, in courts, legislatures, and public policy forums. And we're a trusted source for the media. We get our work done through 3 programs. We're here today to talk to you about preparedness, but in a way, we're also talking about some of the advocacy work that's going on around home insurance, because it's hard to be prepared if you're struggling to keep your home insured. So we're here to help you keep your home insured. So a couple quick messages before we get into the meat of the program. Because our organization has been in the trenches after wildfires in California, earthquakes, floods, and hurricanes outside of California, we have a lot of experience with frustrations that people have on the back end with their insurance after they've had a loss, wishing that they had bought more coverage. Frankly, I don't think I've ever met a disaster survivor who said that they wished they hadn't bought enough, as much coverage as they had. So a couple messages. Having enough insurance, really important. Inventorying your assets, really important and really easy. Now that you have a cell phone with a video feature on it, most of you, just walk around your house narrating, and then make sure that that you save that video where you talk about, here's my bedroom set that we bought at Macy's, or here's my couch that I inherited from my grandmother, et cetera, et cetera. Make sure you save that file somewhere where you'll be able to access it. And then finally, harden your home and create defensible space. If you don't know what that means, you can see our little list of the 4 top things that are credited as being most effective in preventing your house from burning in a wildfire. Okay, so why are we here? Because home insurance for many Californians has become very hard to find and expensive. I turn to Carl Sussman as somebody who sells insurance. He's what's called an independent agent or a broker. Partly because Carl, not only does he have his finger on the pulse of the market, but he is very proactive on behalf of his clients. So he beats the bushes trying to find options, and he can work with a number of different companies. Carl, can you, just looking at this slide here, to talk about why we're here, do you have just a general observation about the current situation for home insurance in California and what you see in the future?
Sure. Well, thank you for that introduction. It makes me feel good to hear. We definitely do try and be proactive. The truth of the matter is there's 2 things that are going on right now, in broad strokes. And number one is that due to the quantity, just the sheer vast number of wildfires that have happened in the last several years and the severity of them, there are many insurance companies that have literally gotten to a place where they realize that the models that they had to try and predict wildfires are no longer applicable. They just can't predict them with any levelance of accuracy to be able to properly price a product. That gives them 2 options. 3 options, I guess. 1, they do nothing and they keep rolling the dice, which is not typically what any insurance company wants to do. They want to work based on sound data. 2, they non-renew risks until they can figure out a way to properly evaluate risks and price them. Or 3, they take large rate increases. And what we're seeing right now is really a little bit of everything. And I think one of the things that we'll talk about a little bit when I chit chat is that things are so dynamic. Literally, there's something that's on one of my slides that is already outdated and it's only a few days old. So the main thing is just to keep your eyes open, keep asking, keep looking, because I can almost promise you that information that you're going to get today, tomorrow, and the next day, some of it will already change by next week.
You know, that has been something very notable to me. And I'm constantly checking in with people like Carl and other insurance agents around the state. How are you doing? Are you being able to place your people that come to you? Because many people have come to United Policyholders to tell us that they've been non-renewed or dropped, and people tend to get very nervous. And so, of course, we're always looking for good information to share. And I think the point that I want to emphasize that Carl just made is that it is a changing situation. So we're gonna, in today's program, we're gonna name some names of some of the companies that are still insuring new risks and taking new customers. And then we'll talk about the FAIR plan. But whatever we're explaining to you, just know that continuing to shop is going to be your best bet if you've had to either settle for a policy that's not your ideal, or you're paying more than you really feel comfortable, can afford to pay. All those things. If you don't find what you need this week, look again in 3 weeks, you might find it. So that's a reality that I've heard from pretty much everyone on that does what Carl does. All right, but our organization is working very hard to deliver a long-term fix and also to give you shopping guidance in the here and now, the way things are, not the way we would like them to be. Obviously, no one is excited about the wildfires that have been hitting the state. So how are we helping? How is our organization helping? Webinars like this, publications that you'll find on our website, an initiative that I will mention briefly later called WRAP, the Wildfire Risk Reduction and Asset Protection Initiative. And really, we are pushing insurers as politely but firmly as we can to get on the bus with us and really help their customers keep their assets insured, partner with their customers, not just punish, not just drop, but help us help you make your homes more wildfire resistant. So the initiative that, and give you rewards, the initiative that I mentioned, the WRAP project, is really aimed at getting a statewide program in place so that if you do ABC, you will get some kind of an insurance reward. So that is basically the goal. We are trying to get more people involved in wildfire risk reduction around the state as a partial way of getting insurers to be more comfortable coming back in, but also because it makes good sense, right? Everyone would, it's better if your house doesn't burn at all, right? And you never have to use the insurance. So yeah, we have an initiative going. We have a working group. We're working with firefighters and the Department of Insurance, and there's some success on the horizon already. Just a couple weeks ago, the State Department of Insurance announced that they, with the Office of Emergency Services, are going to be setting standards. That was always the first step, setting standards for that insurers at some point are going to have to recognize, because we really do understand how much frustration there is out there of people who have replaced their roofs or done things to make their homes more fire safe, and they still got dropped. And that I know is painful, frustrating, and we're trying to fix that. Okay, so couple more resources from United Policyholders on to shop. Those are both available through our website. You can use somebody like Carl, who's an independent agent or broker. You can use a tool called the Matchup Insurance Finder to also get some quotes. And then the Department of Insurance offers a website, and these are all ways for you to find the names of companies that might insure your home that you may not have heard of. Obviously, everybody knows the big name companies. They advertise every time you turn around. But a lot of folks these days are having to be insured through companies whose brand name is not familiar to you. And that may be okay. And that's part of what we're here to talk about today is how do you know if it's okay? Four little pieces of lingo I want to make sure that are clear so everybody is on the same page here. Um, Dropped, non-renewed, same thing. Your insurance company no longer wants to insure your home when the current contract expires. A difference in conditions policy. Carl, you want to explain what that is?
Sure. It's actually a more generic insurance term than we're using it with here, but it's basically in the terms we're talking about it, it's a policy that's designed to go in conjunction with another policy, in this case, with the California Fair Plan. We'll talk about the California Fair Plan, what it covers and what it doesn't, but in a nutshell, what is not covered by the California Fair Plan can usually be covered by what's called a DIC policy.
All right. And I know you have a very good illustration of that we'll see in a couple minutes. Admitted versus non-admitted. So, just like every other field, insurance has a million acronyms and there's so much lingo. And part of UP's job is to try to simplify things for you so you can understand it. And there really are two basic kinds of insurers that we're talking about today. One is an admitted, meaning fully regulated, or non-admitted, which is a little lighter regulated. And it's a choice that an insurance company has. They can decide to be fully regulated and admitted, or they can decide to go the lighter version. It's more complicated than that, but what matters for you today is that many of the companies that are picking up homes in California that other companies are dropping are non-admitted. So those are those unfamiliar brand names, lightly regulated, still regulated, but lightly because the very last item on this slide explains something called CIGA, the California Guarantee Association. And that is, it's a pool of money that all the admitted, fully regulated companies pay into that is available if they go belly up, if they get so many claims at once and they cannot pay them, so they don't have enough money, then CIGA is there to pay those claims that they don't have enough to pay. The problem that you have if you go with a non-admitted company is that they don't participate in CIGA. So if they go belly up, you don't have that safety net of CIGA. And so it ideally, you do want to be insured either by an admitted company or a non-admitted company that's got plenty of dough, like a Lloyd's company or something like that. And we're gonna give you a link to figure out some stuff there. Okay, so some of the current options in California. Carl, you want to take us through this list?
Sure. First, I'm glad, I'm really happy to hear the way you describe the difference between admitted and non-admitted, because there's a lot of confusion sometimes that going with a non-admitted company is just inherently bad.
Right.
And it's actually not at all. One of the reasons, a lot of times, actually, some carriers will specifically decide for business reasons that they want to be a non-admitted carrier. And it's not simply because they don't want to contribute to CIGA. It's because they want to be able to have more flexibility in how they will underwrite and take a risk. If you're an admitted carrier, before you can, for example, file rates, right, for how much you're going to charge, or you have to file guidelines for what's acceptable and what's not. You have to get that approved by the California Department of Insurance, in this case in California. A non-admitted carrier can make those changes at will. And an example of when that becomes important is there might be a policy that excludes coverage for animals, right? And that's just the way it's filed. So someone might have a dog bite claim, but they can't find homeowners insurance because the policies will exclude animal liability. Well, a non-admitted carrier can step in and say, okay, we're going to just exclude liability for Fido, that specific dog. Or maybe that dog's dead. And they can say, okay, we will not exclude liability because we understand that animal is deceased. Whereas an admitted carrier doesn't have that flexibility because they have a filing with the state Department of Insurance. And it says, if they have one of these dogs or they have a dog bite claim, we can't accept them. So not to go off too far, but I'm glad that that's something we should keep in mind as well. that the non-admitted carriers are not necessarily or innately bad. It just means that they don't go based on rules and guidelines that are within the box, right? They can do whatever they want. And to Amy's point, the most important thing is to be sure that you're with a non-admitted company that has sufficient assets. That's really what's important. You'll find that a lot of admitted carriers have a lot less money than we would expect for an insurance company, but because they're admitted, people just assume, hey, it's okay, they're admitted. So most important thing again is to keep track of the financial status of your insurance carrier. So we'll buzz through these quickly. The California Fair Plan is an option for fire insurance and some other things as well that we'll talk about a little bit later. Attain is a new non-admitted company that's recently come in to the California market. Guard, which is owned by Berkshire Hathaway, which is owned by Warren Buffett, our buddy, is also taking insurance in California. Bigfoot is a non-admitted carrier. They jumped in and now they're not quite as aggressive. Lloyd's, which is Lloyd's of London, and Scottsdale. Scottsdale, by the way, is owned by Nationwide Insurance. So again, at first blush, you'd say, oh, Scottsdale, non-admitted, bad. But if you step back and you realize that they're owned by Nationwide Insurance, which of course is a massive insurance company in almost, I think they're in every state. So, again, State Farm, they are still writing business for new customers in California. Lexington as well. And Heritage also is a non-admitted carrier that is writing in California. And also some of the guidelines that you see we have written here that say 150 to 200 feet brush clearance, things like that. What makes it challenging again for a lot of people is that who's going out there with a tape measure? Are you? Probably not. Will an inspector? Perhaps. Is that grounds for denying a claim if you're signing an application that says you're 200 feet from, you have 200 feet in clearance and you don't? Possibly. So these are things that you need to keep in mind also when you're talking to your agent or broker, that when you're signing an application and you're basically saying, I qualify based on these things, be sure that you're reading it, because those are things that can sometimes come back to haunt you.
So you can see at the bottom there under Heritage, conservative on ITV, that stands for insurance to value. And that really basically just means they want to make sure that your house is properly insured, maybe even Carl might suggest even a little overinsured. So when he says conservative on ITV, he's saying this company will definitely put a higher dollar figure on than you might see recommended from other insurers. Just a few more. Foremost, Stillwater, Travelers, American Modern, Pacific Specialty. Anything else you want to say about these companies? These are all maybes that we're throwing out there. None of these are guaranteed to anyone. Every house gets looked at generally individually by an insurer if they are at all open at all in that area. Carl, anything?
No, I agree. And that's an important point also, that just because the carrier's name shows up here, that doesn't mean that you can get coverage. It just means that there's enough volume that we see from these companies that if you're talking to your agent or broker, you can say, by the way, do you have access to this insurance company? Do you have access to that insurance company? And some brokers will have access to more carriers than others. Not a good or bad, it's just sort of the way the business works. So if you have a list of some of these carriers that you can ask about, you can be sure you'll get an idea if they're really able to shop around, or if their menu is 2 items or 3 items, then you probably need to make some phone calls or go online and find a brokerage that has access to more markets, because these days the more markets you have, the more likely you'll be able to find somebody that will take the risk on for you.
Yeah, and I'm going to go back for a second and point out that it says here State Farm is picking up new customers. Now we didn't go into great detail about the difference between somebody like Carl, who's a broker or independent. He can put you with any one of a number of companies with whom he has a relationship. But Carl, State Farm, I mean, can I call my State Farm agent, a State Farm agent? And are they gonna, can they help me in this situation?
Yeah, there's basically a specific legal definition between an agent and a broker. In the case of State Farm, they are State Farm agents, which means by definition and by law, and not trying to preach law, don't want to cross that line, they legally represent the insurance company. So they can offer State Farm products and State Farm services only. So it's, circle for the circle hole peg, that's it.
Right.
Whereas a broker, by definition, we work for the client. We're basically retained, you could look at it that way, by the client to find an insurance company that works best for them. So we don't have the one size fits all. We have to try, and by we, I'm not saying my office, I'm saying any independent agent has the ability to go to any insurance company that is available and say, how about this? How about this? How about this? And try and find the right fit for the right risk.
Yeah. Okay, so if you do go with one of these non-admitted companies that you've never heard of, and you want to have some assurance that they've got enough money in the bank, and that they have a good rating, you can try AM Best. They have a free toll-free number, and they rate insurance companies A, B, just like school. And you can ask, and they will give you that information for free. That's one place. Carl, tell us about this list. What is this? What? Now, this is a list you can find at the California Department of Insurance, insurance.ca.gov. What is this?
This is a beautiful picture of Ricardo. What do you mean? Oh, you're talking about the list. This is called the Leslie list. And basically, like Amy started out by saying when she was talking about admitted versus non-admitted, and that the admitted carriers were strictly regulated, I think was the word you used, and the non-admitted carriers were more loosely regulated. This is a way that the non-admitted companies can be regulated a little bit more. And what it means is if a non-admitted company is on this particular list, the Leslie list it's called, then you can rest assured that they're not, what's the right word? They're not fly by night. They're not here today, gone tomorrow. They've been around a long time. The California Department of Insurance has checked on their claim history, some of their finances. I don't have the specifics for what the guidelines are that the Department of Insurance looks at, but if you're going to go with a non-admitted company, as important as checking their finances, take a peek, see if they're on the list. Okay. And if they're on this list and their finances look good, and these are just two simple questions you can ask your broker if they're giving you a quote. Just say, what's their AM Best rating? And are they on the Leslie list? And you can get those two answers, and that will tell you a lot about whether it's a good carrier to be with or not.
And you can see on this list, for example, not all non-admitted. Surplus lines is another bit of lingo, means the same thing. Surplus line, non-admitted. You can see a name that you probably recognize, AIG. So not every company that has chosen to be lightly regulated and is non-admitted is a brand name you've never heard of. So it's a corporate choice that AIG Specialty Company made, not to be admitted in California. Okay, so but no matter which insurer you end up with, we want to remind you, that your dwelling coverage A limit should be enough to replace your home with one of similar size and features. And we harp on this because 30 years of bringing our Roadmap to Recovery program into wildfire impacted regions, 2/3 of the people, almost every time, don't have enough insurance on their dwelling to replace it stick for stick, board for board. So because that is such a problem, it's so common, we have all kinds of information to help you avoid that. We do things like this event where we're trying to give you information, and really give you the straight scoop. But we also have a lot of materials on our website. We do programs in communities to try to really explain this. And again, we don't sell insurance. We don't take money from insurance companies. We really, have no financial stake in you picking one company over another, or whatever you decide. We just want it to be in your best interest. We don't have a horse in the race, as it were. I don't like to use the dog in the fight saying. I don't like dog fighting. Okay, so it doesn't matter to us, but we want if you're spending money on insurance, we want you not to be in that 2/3. Well, of course, we don't want you in the 2/3 of wildfire victims that are underinsured because we don't want you to lose your home. But if you, God forbid, did, we would like to know that you went to one of our programs and you learned that you cannot blindly trust that your insurer or agent has fully covered your house. And therefore, we recommend a little bit of due diligence. And one of the easiest things you can do is look at your policy, look at the amount of coverage you have for your dwelling, and then divide it by the square footage in your home. And that will tell you approximately how many square feet, I'm sorry, how many dollars per square foot of insurance you'll have available. So in this example, you would have, if you had $800,000 of coverage on a 2,000 square foot home, you would have about $400 a square foot to pay a builder to put that house back. So I'm simplifying it because it's in real life, it's really hard to know how much it would cost to put your house back because of inflation, because of materials from China getting delayed, or there being a tornado where in a nearby state where suddenly all the lumber is going there, and so it gets more expensive here. But generally, this is a pretty good, just basic way of knowing whether or not you have enough insurance. We tell people 15 minutes isn't enough time to calculate your home's replacement, but that is common. Carl reminds us to remind you that nobody knows your home better than you. So, that 15 minutes came from an insurer ad, right? 15 minutes will save you 15% or whatever. And that may be okay for auto, not for home. And so we really want to kind of emphasize that. So even though, and I know these days people feel in a lot of parts of California, you just feel lucky to even get any policy, let alone enough, a policy that's going to give you enough. So Carl, any words of wisdom, if a customer is, your client is struggling, they've got sticker shock from the premiums, when they've lost the old policy, that you're shopping for a new one for them, and they say, look, what can I cut? What can I do to bring this down? What kind of advice do you give?
It's a great question. And, we deal with this all the time, as you can imagine, because those three things are happening with all of our clients, as well as new people that are coming to us. The easiest thing to do to save money on your premium is to just raise the deductible. What you don't want to do is lower the coverage, right? Because what's the difference if you're able to save money if now you don't have enough insurance to rebuild your home?
Right.
What I'll tell people is look at a $10,000 deductible, look at a $25,000 deductible. It might sound outrageous, but if your home burns to the ground, $25,000, it's not a lot when your house is maybe insured for $800,000 or more than that. So try not to be so shy from some of those larger deductibles. I look at it sometimes like medical insurance. Years ago, medical insurance was just if you end up in the hospital, you'd have insurance for it. And then it became, well, we'll pay also if you go to the doctor. And then became, well, I want to go to the doctor and I just want to pay a little bit, like a copay. Right. And then we've gotten to this place now where people don't want to spend anything when they go to the doctor. Our expectation as consumers is that we can go to any doctor, we just pay a couple of bucks and they just take care of us. And so health insurance premiums are ridiculous, in part because of that, because it's shifted from what was designed initially to be more catastrophic to, I want to go and get a checkup, or I just want to go and because I cut my finger and have it looked at, and I only want to pay a few dollars for it. So the premiums reflect it. And homeowners insurance in California is really going through sort of a shift like that, where as consumers, we really have to start looking at it, especially when we're in areas that are, let's face it, they are more likely to burn than others. We have to understand that in order to insure them, we're going to have to take on some more of the actual risk by taking on a larger deductible to keep it affordable.
Yep, it's true. And I can say, I carry a higher deductible than anyone I know. I have a 5,000 on my homeowners, and of course with earthquake I have 15%, which is, but Bob Hunter, who used to be the insurance commissioner in Texas, and he's the insurance guy for the Consumer Federation of America. Same thing, $5,000 deductible on his home insurance. I'm not going to ask you what yours is, but you're welcome to volunteer it if you want to.
Oh, you asking me?
Oh, sure.
Yeah, I have a $10,000 deductible on my policy.
Yeah.
And the truth is, because at the time that was the maximum that was available.
Oh,
When it
okay.
renews, I'll look to see if there's a higher one.
Yeah.
We could go down a whole rabbit hole of, well, you wouldn't want to put a claim in for a couple of $1,000s anyway, because
Right.
then you have, again, now you're a different risk profile, right? You're no longer a claim-free person. You're a person that's had a claim. So your rate could be subject to increase. You could be subject to non-renewal depending on the insurance company. So if you're not looking to put a claim in anyway, it makes even more sense to look at a higher deductible.
Yes. So just a very, very brief review of what matters. Replacement coverage over actual cash value. So that's having coverage to replace what you had at current prices is much better than having coverage that will only pay the used or Craigslist or depreciated actual cash value. Obviously, well, maybe not obvious, but I'm going to tell you that ACV coverage is much cheaper. And so I'm sure it's been very tempting for a lot of people to try to save money, to think, well, maybe I should go ACV only. We strongly recommend against that. And I don't really know that how much proof is there anyway, Carl, that you're going to get a much better deal on an ACV only.
You won't. I don't know any carrier that's offering will only offer an actual cash value policy, but not replacement cost. As a matter of fact, I also do insurance expert witness work in complex litigation cases. And if I see a homeowner's policy written on an actual cash value basis, 9.9 times out of 10, it's just a blatant error. It wasn't supposed to be that way. It's not even significantly less expensive. So
Okay.
yeah, you definitely want to be looking not only for replacement cost, but extended replacement cost when you can get it.
Right. And there are now some laws in place actually that require insurers to offer you both extended and building code upgrade coverage. Those are both really important in California. And then having, as we mentioned earlier, having adequate limits, meaning the maximum insurance that's available on your dwelling and also on your ALE. There's another bit of lingo, I apologize. That stands for additional living expense, which is that category of benefits that covers your living expenses while you've lost the use of your home. Sometimes it's called loss of use, sometimes it's called temporary living expense, additional living expense. It's basically the bucket of coverage that you'll have for your rent and your extra mileage and extra food expenses and all that. Again, California now by law requires at least, actually requires the insurers, your policy has to have 36. So it's, in some ways the law is protecting you now with all those three things: extended replacement, code upgrade, and ALE. The carriers now must offer you a certain minimum amount. Extra for art, jewelry, business property, because there are what are called internal limits or caps that you might not even notice on the front page of your policy, or your agent or broker might not tell you about, but we're going to tell you about them. And so if you have those things, it's been my experience that getting a rider or scheduling those items, basically specially insuring them, is not going to break your budget. But Carl might have some other views about that, but we are going to get to that. Knowing what's excluded, unless you have a separate flood policy, chances are you do not have coverage for flood damage or earthquake. Mold may be limited in your policy. Earth movement is almost definitely limited as well. And then debris removal, demolition, very important that you have that there be some coverage for that. And what we are going through right now in the state of Oregon, where a lot of debris removal coverage is not a separate bucket as it normally is in California, but that for people up there, mostly they have the only amount of money they have available for their insurance to pay for the debris to be removed is a chunk of their dwelling coverage, and sometimes it's not enough. So it's just one of those things that you want to pay a little bit of attention to. And then, of course, the deductible, which we talked about. So these are some of the questions to ask an insurance agent. But before we go any deeper, I really want to get into Carl's presentation, because his slides are much more jazzy than mine. But I'm just going to really just zoom through. These are the questions that we recommend you ask. Will this policy cover the cost of rebuilding my home to its pre-loss condition? What causes of loss are not covered? Will it pay to upgrade my systems if I have to make repairs or rebuild? How long will my temporary rent be covered? Basically, these are questions that relate to what we've been already talking about. If you have a home-based business, very common that there will be either a flat-out exclusion for a home-based business, or there will be a very low limit on business property. Anything that you want to share on that point, Carl?
Home-based businesses, especially these days, a lot of people, obviously, you may have heard, are working from home. And that trend will probably stick. Home-based businesses, you can literally, and I'm not exaggerating, get a very comprehensive home business-based business policy for $200 a year. They're sold standalone. They're very easy to get. But like Amy said, most insurance policies, homeowners insurance policies, will exclude that coverage because, again, what is a homeowner's policy? Well, it's there to rebuild your home and protect your personal liability in broad strokes, right? Nothing about business. So it doesn't cover those things. So even though we're starting to do that a lot more often, people need to sort of be like you're saying, buyer beware. These are things that can be excluded, and you need to be able to either ask for the coverage or at least be aware that you're running around doing this without coverage otherwise.
Yes. And then what discounts do you offer? How do I qualify for them? And how much can I save if I increase my deductible? You can have a flat, 500, 1,000, 5,000, 10,000, or it's getting more common for an insurer to either offer or to put in a percentage deductible. I'm not on the same wavelength with Carl on this. I personally don't like percentage deductibles because that math equals mistakes, right? So I feel like people get very confused. Is my deductible, when I first saw percentage deductibles coming in Colorado, State Farm started doing a 1% instead of a flat. And I just thought that's going to lead to disputes because people often don't understand, is my deductible a percentage of the amount of the loss, or is it a percentage of the amount I'm insured for? So Carl, you said you kind of you like the idea of percentage deductibles in some situations. Can you explain that?
Sure. I mean, I'm not a fan of extra math. I promise you that. It's not that I'm so much of a fan of the percent deductible. I'm a fan of the fact that there's a way to get a higher deductible to save money. And that, in a lot of ways, is where you'll see some significant cost savings, is with those percentage deductibles.
So, all right. So this is just an illustration of some of those common sublimits and caps that you see: furs, jewelry, silver, business equipment, money, stamps, collections of watches and art, guns. Those are very common. So Carl, actually, I'm gonna stop sharing so that you can now share and take it away.
Okie doke. Let me click a few buttons here, and then you should be able to see the beginning of my slide, and then we'll jump right in. Okay, does everybody see the slide with the wonderful
Yes.
house on fire? Isn't that a wonderful way to start? Is it there, Amy? Everyone, is it?
Yes.
Okay, great. Well, first, everyone, you've been sitting all this time. Feel free, take a few seconds to stretch. It's Zoom fatigue. I totally get it. And this presentation is there's a lot of information that I'm going to try and get through quickly. I think that if you have questions, I actually just minimize the chat, but I will stay as long as Amy is okay with us to answer questions at the end. So if I go through something quickly or something else comes up and you want to ask a question, just hang around and we'll go through it. Again, tons of information, but I think you'll get a lot out of it. Basically, what I'm going to be going over in the presentation is what we're going to learn is why we need fire insurance, where we get fire insurance from, what do different fire insurance policies cover, why it's difficult to get fire insurance today, how the insurance industry is responding to these losses, what to expect from the fire insurance market, and then questions and answers. So yeah, it seems like a lot. So I'm going to buzz through it a lot faster than normally, but I want to make sure that I touch on everything for you. So the first thing, why do we need fire insurance? Well, the obvious, again, like we said, it's terrible when you say obvious. If it's obvious, why do we have to even say it? Almost condescending, right? It's not obvious, but one of the reasons that we want property insurance and fire insurance is to protect our properties. A single family home can tend to be someone's largest investment of their life. So you want to make sure that you have the right coverage to protect the largest investment that you have. The other main reason is lenders require fire insurance. So you're going to a bank, you're getting a loan, they're going to want to have protection of the collateral that they're giving you money to buy. And so they're going to require you having fire insurance. Let's see. California's population as of July 1st was, wow, almost 40 million. About half own their homes. I thought that was actually interesting. I didn't think that many Californians could afford to buy their home, but they did. So that's roughly 20 million people that need fire insurance. Fire insurance policies protect everything from your actual home to the personal property. If you own a rental property, they'll pay for that. Even commercial buildings, if you're a landlord or owning a commercial property for a business, all of those things, including the equipment inside, can be covered on fire insurance policies. As I said, we're talking about lenders needing the collateral covered. You can tell that I'm going through this quickly because normally I'll sit and I'll walk through every one of these slides and explain it to you, but I've already said it. So now you're already ahead of the game. As you probably know, California's real estate market is extremely important to the entire economy in California, and the insurance market is connected to the real estate market. So it contributes $1.9 trillion to the economy, the real estate market, just in California. So putting that in perspective, that's almost a quarter of this country's economy comes just from the real estate market in California, and insurance is connected to that. So what we're talking about affects everybody, not just people that are in high risk fire zones, not just someone whose home might have been non-renewed, but the economy at large. So let's talk about where we can get fire insurance. We can get them from private insurance companies. We're pretty familiar with that, right? And we talked about admitted insurance companies and non-admitted companies. I think we've beaten that one to death, but if you have questions about it, feel free to still ask. We can touch on it again. Some admitted insurance companies you might be familiar with: Travelers, Mercury, Hartford, Safeco, Nationwide. But as we also noticed, if you remember a few slides ago that Amy had, Nationwide, was it Nationwide or AIG? Sorry, it was AIG. But I want to make the point that Nationwide has both admitted and non-admitted insurance companies. And again, they do that to be able to have more flexibility. They'll go with their admitted market for certain products, but if they want to sort of color outside of the lines, then they'll use one of their non-admitted markets to do that. Non-admitted companies, again, they're not specifically licensed for the state to do business here, but if they're part of that Leslie list, again, and they have a large financial backing, then you should probably feel comfortable working with them. Since I put this slide together, Aspen is no longer writing in California. Just like I said, things change so quickly. Who knows what tomorrow will bring? So it's important, again, that you're always asking around and always checking around to see that you can get the best thing that you can. As far as admitted companies, who would you guess has the largest share of homes insured in California? Anybody want to venture to guess? How about you, Amy? You put me on the spot enough times. You guess. Oh, she's muted. See, she was being so polite, she muted herself.
State Farm.
There you go, State Farm. You got it. Maybe did I preview this with you? Yeah, State Farm has 18% of all the homes in California insured, followed by Allstate at 8.5%, Liberty Mutual at 6.9%, USAA, Farmers, Travelers. So those are some of the, quote, as you're saying, name brand larger players in California. But is there anywhere else to get fire insurance coverage? And of course, the answer is yes. Fire insurance coverage can also be obtained through our friends at the California Fair Plan Association. And I do want to talk a little bit about the California Fair Plan, but I want to give you some stats on them first and just a little history. They were initially created in 1968 following some fires that happened, and they were designed to offer fire insurance to people that, for some type of reason outside of their control, they were unable to obtain insurance in the regular, what we call their standard market, those admitted companies for the most part. Now, the California Fair Plan is not a state-run agency. Okay, it's not run by the state. It's not the state of California. There's no public funding or taxpayer money involved at all. Surprise, surprise. Fair Plan is actually stronger than any single insurance company. Let that sink in. It's a simple fact of dollars and cents. Well, Fair Plan gets its money from all of the admitted insurance companies that write property insurance in California. So if you take every single insurance company admitted to do business, they all contribute money to the California Fair Plan to pay the claims, and they all get their share of the premium that comes in. So in order for the California Fair Plan to run out of money, they would literally have to have every single admitted insurance company that contributes run out of money. Well, I don't think that's going to happen. If it did, we would have much bigger problems than getting our home insurance covered. But let that sink in for a minute. It's not that the California Fair Plan is in some way small or some big bureaucracy that doesn't have money. They are an independently run organization with the financial backing of every admitted insurance company that writes property insurance in California. That's a lot. So how you can buy a policy through the California Fair Plan? Through your good local independent insurance agent like yours truly, shameless plug, or you can get it from a captive agent. So for example, we talked about State Farm, for example. State Farm can only write with State Farm, but by law, they also can write through the California Fair Plan. Captive agent is State Farm, for example. And direct from the insurer. You can actually purchase insurance from the California Fair Plan directly from the California Fair Plan. Purchasing it through any of these other two channels will provide you with the exact same premium. There's no additional cost to go with an agent or a broker, but you are able to get it directly from them if you so desire. So I'm going to go through these slides really quickly. Now we're pivoting from just fire insurance to a homeowner's insurance policy, right? So when we think of fire insurance, we can pretty much conceive of fire, but most of us have homeowner's insurance. And homeowners insurance covers much more than just fire. And I'll run through these quickly. Homeowners insurance policies will cover everything from fire and lightning, coverage for freezing, aircraft, water damage, theft, medical payments, windstorm or hail, damage to property of others, falling objects, smoke damage, explosion. There's general liability. There's the weight of snow or ice, workers' compensation coverage, electrical current damage, riots, vandalism, and damage by vehicles. So this is a brief,
All the
small
fun
list. What?
All the fun stuff.
All the fun stuff, right? But these are things that you have if you have a standard homeowner's insurance policy. It's a lot. Now, California Fair Plan is not going to give you all of those things. The California Fair Plan is going to cover fire and lightning, smoke damage, internal explosion, windstorm, hail, riot, aircraft, vehicle damage, vandalism, and malicious mischief, which that's, I think, only the second time in my life I've been able to pronounce that without skipping. Malicious mischief. Apparently there's another type of mischief that's not malicious, but they will cover the malicious kind. So the question is, if this is all that Fair Plan covers, is there a way to get the fire insurance through the California Fair Plan and get everything else some other way? And the answer is yes, and we touched on that briefly, and that's with a DIC policy. The DIC policy fits along with the California Fair Plan policy, and when you put the Fair Plan together with the DIC policy, you have what's as close to a full homeowner's policy as you can get. So someone that gets fire insurance through the Fair Plan and a DIC policy does not have something less than. It's not some type of oh darn, or oh my God, I gotta find something better. That's good coverage. That's comprehensive coverage. You're not lacking in something obvious or significant if you're obtaining your insurance through those two portals. I'm going under the auspice that you're getting a DIC from a reputable company, of course. But in general, having a fair plan policy for fire and a DIC policy for everything else is completely comprehensive. So why is it difficult? Why are we here today, basically having this webinar? What the heck is going on that we've got 100 and I don't know what, 60 some odd people that are here trying to find out how to get fire insurance? What has happened? Well, we can look at some trends. In 2015, we can see that there were 880,000 acres burned in wildfires. In 2016, another 669,000 acres burned. In 2017, that jumped to 1,548,000 acres burned. 2018, 1,963,000 acres burned. And the last number we had, it fortunately dropped down in 2019 to 259,000 acres burned. I'm not going through all of the numbers, but you can see at the bottom, if you're looking on the slides, we're talking about tens of thousands of homes that were lost. Now, I'll let you know a little secret. Each of these squares are what are considered 10-year events, meaning that when the insurance companies are pricing their products, they assume they factor in one of these events happening every 10 years. Well, we've had them 1, 2, 3, 4, 5 years in a row. That's why we're here. We're here because the pricing models, the actuarials work, everything that we've known in the past to be able to predict these types of events, it's not working anymore. So we have those three things that the carriers are doing, right? Frequency and severity has gone up, right? The frequency of wildfires and fires in general has gone up, and the severity, the average amount of each claim has gone up. The replacement costs have gone up year over year over year. And here I've got a pretty little slide about this being these 10-year events. And I quickly touch on why do we think it is? Well, the general consensus is climate change, and I just leave it at that because it gets people's feathers ruffled. Suffice it to say, whether we want to take that as the reason or not, we do have simple numbers to show that the amount of losses that we're having and the frequency that they're happening are much more frequent and more catastrophic than they've been ever in our recorded history. And so the insurance industry has to find a way to respond to that somehow. Right now, they're in that in-between stage, like I said, of either non-renewing, raising rates to try and compensate, or just doing nothing. So here they are in slide format. Insurance companies starting to non-renew homes that are in high brush areas. Now, what is a high brush area? Well, that definition, by the way, there is no specific definition that's acceptable by every insurance company by what is brush. What is brush to Mercury Insurance Company might not be brush to Travelers Insurance Company. So don't get caught up on I'm in a brush area. There's no such thing per se as a brush area. What one person considers brush, one carrier, another might not. State Farm, as we found, the largest property insurer, non-renewed over 350,000 policies that were in high-risk fire areas. There was some emergency legislation that was put into place to put a temporary hold to prevent them from non-renewing those policies. But as you can imagine, as soon as they're able to, they'll non-renew them because, again, they're not able to sustain that amount of risk over and over and over again, and they can't price for it, at least not yet. The California Fair Plan even has taken rate increases of over 20%. In some cases, in more than one rate increase in 1 year. Mind you, Fair Plan, they're not a nonprofit. They're designed to make profit, but a very small amount of profit. And as it turns out, their rate increases are small compared to what they're paying out. Admitted insurance companies, as we said, are continuing to file for rate increases to try and offset all of these claims that they're having. And the non-admitted insurance carriers, right? These are the guys that don't have to get permission to raise their rates, have gone up sometimes over 500%. Keep in mind, at the end of the day, whether they charge you $1,000 for your premium or $10,000 for your premium, if the house burns down, they can't collect enough money to be able to sustain that type of a business model at any price. So the short-term solution is what we're dealing with right now, which is juggling some carriers in, some carriers out. The long-term solution is still being worked out. The governor of California did declare a state of emergency. Ricardo Lara did enact some legislation that I talked about to prevent insurance companies from non-renewing, and they're tightening guidelines as well. So in the long haul, what should we expect from the fire insurance market? So I would expect, and again, I have this slide just to be able to remind everybody that, you know, insurance companies, they are for profit. They're not nonprofit companies. They're there to make money. If they can't make a profit, they're not going to play. It reminds me of a story. I have a client once, I remember, and he had a couple of claims, I think 3 or 4 claims, and then the insurance company non-renewed them. And he was upset. He says, why are they non-renewing me? It's their job to take the risk and pay the claims. And the story that I was reminded of was my brother-in-law, who worked for an insurance company in claims, actually. He said, well, imagine you go to Vegas and you're playing roulette. You put money on red. They spin the wheel, you lose. You put it down, they spin the wheel, you lose. Maybe you put it down a third time, spin the wheel, and you lose. Pretty soon, you're not going to want to play anymore. And the insurance carriers really are looking at it that way. They're going to keep trying, but at some point, if they keep losing, since they are for profit, not only are they not going to want to play anymore, but they won't have the money to do it. And again, I'm not one to toe the company line for sure. I mean, Amy will be the first one to tell you that. I'm not one to sit and play the violin for the insurance carriers. Believe me, they're doing just fine. But at the end of the day, there's not enough money to perpetually go on and continue to pay for significant claims that have been happening over these last few years. There has to be something that changes, some way to share in that exposure, especially in areas that, let's face it, are going to have continual fire damage occurrences happening.
I mean, Carl, I gotta interject here because I'm sure that people are thinking, and I certainly am. I am thinking, well, what about all the other years where there weren't those losses and we didn't get rebates, right? And wait a minute, aren't there? I think like 15 million insured homes in the state, right? I think.
Mm-hmm.
So 24,000 total losses in a year. It sounds like a lot, but it's spread over all these different insurance companies. There's a part of this that may be an overreaction at some level. Do you agree with that?
I'd love to agree with it. I wish it were true, but for better or for worse, California is one of the most heavily regulated states from an insurance standpoint. The California Department of Insurance does not let an insurance company take a rate increase unless they can show them in plain numbers that they have lost money. And even if we assume that they're playing with the book somehow, or they're doing a little something here or there, which who knows, might be true, as an industry, if you add up the dollars that have been lost, then you're gonna erode at, as you picked 15 years, without losses, you're going to erode out of that profit pretty quickly. And again, you're right. Rebates don't come when there's no losses. And well, except for now with auto insurance, there were a lot of rebates coming because everybody was driving less, and the insurance carriers started giving some money back for that excess profit that they were making. But they don't do that with homes over the last, historically. And similarly, they can't go and assess somebody because they're having large losses. But in general, and maybe it's a good slide for me to dig out and create, you will find that there's something called a loss ratio, right? It's the ratio between how much money an insurance company gets versus how much they pay out in claims. And what used to be back in the 80s or so, when I was 10 years old in the 80s, kind of no one will buy that anymore. Oh, well, anyway, years ago, a loss ratio would be in the 80s, right? So they would get 100 cents and they would pay 80 cents out in claims, and the 20 cents on every dollar was profit. Over time, that was eroding away. And now over the last several years, the vast majority of the insurance companies are running post 100% loss ratios, meaning they're paying out more in claims than they're collecting in premium. And it's just dollars and cents. it's not a reaction or not, it's just math. And again, some carriers are thinking, well, we'll weather the storm, bad pun, but they'll weather the storm. And others are trying to get rate increases to try and offset it. Some are just restricting the guidelines to be able to slow the flow of business that comes in. But it's just dollars and cents in there. There's, again, I know that we're a skewed group because, you know, I deal with clients every day. Everyone on this call owns at least one home, probably. Our clients represent thousands of homes. And so I have to deal with and feel for and try and take care of all of the people that have had those losses. So I see it all the time. So I'm not crying the blues for the insurance companies. I know what happens when someone can't get insurance, what the premium looks like, or when somebody's in a position where their claim is not being paid because they don't have enough coverage. I see that stuff all the time. Yeah. So in general, yeah, I think that there's a knee-jerk reaction that they're trying to fix at this point. I just don't think anybody really has the solution per se. That's really what I think it's coming down to right now.
Agree, and that is one of the reasons why my organization is working so hard to try to get a program into place so that there is so that we are all kind of pitching in, all the homeowners, you know, pitching in to try to do their part, and their communities will be doing their part, and then the insurers will give them some kind of a break, which will make it more financially appealing for people to spend money reducing risk. But that's a whole other, you know, story for another day. So we should get back to the.
Yep. I'm just about done. These are just a few little things that I had on the FAIR plan that had changed. You know, they're accepting credit cards. That's new. They're writing higher limits. That's new. You know, I'm going to skip through most of these. We've talked about it at some point or another today already. But these are things that are happening, right? Companies are going to be more picky about the risks. They're going to have higher rates, and they're going to be requiring more from the homeowners, whether it be offering a wildfire deductible. That's actually very common now, where you'll see, let's say, $1,000 deductible on a homeowner's policy with a $20,000 wildfire deductible. That's not uncommon to see. That's their way of trying to sort of bridge that gap. I would expect to see rates continue to increase, unfortunately, until there's some semblance of balance that happens. And unfortunately, it's bad for everybody. Believe me, the insurance carriers don't make more money on higher premiums, because in order to get the higher premiums, they have to prove the level of losses paid out. Think about that loss ratio again. Getting a 99% loss ratio where they make 1%, let's just say, profit out of every dollar, doesn't matter if it's of a large premium or a small premium, it's still 1%. So that's probably not the right way of explaining it.
We're delivering not great news, right? That your summary is not great news, but we're here to try to make the best of a bad situation, meaning not so much make the best of it, but thank you, Carl, but really, but really deal with the situation as it is. So if you can unshare, I will.
I shall do that.
Mine, and we will hopefully get back to where we.
All right, you have the control.
Hang on 1 second. Okay. All right. Okay, Carl. There we go. So just a touch on earthquake is the majority of people in California have decided that they don't want to pay for earthquake insurance, but we always want to remind you that having no earthquake insurance at all is like having 100% deductible. It'll all be on you. So it's never a bad idea to get a quote. The market is still pretty limited. Most people who have earthquake insurance are insured through something called the California Earthquake Authority. You can get all kinds of good information at uphelp.org about your options. If you're a CEA policyholder, California Earthquake Authority policyholder, you can apply for a grant to do some seismic upgrades. But we say, check, because Carl just told me about a company called Geovera rolling out a new option, and it's kind of like what we said in the beginning. of the program today is that the marketplace is dynamic, and options are, there may be options now that there weren't when the last time you shopped. So it's always a good idea. Not anyone's favorite way to spend free time, but definitely from your personal finance and your personal financial health, it's a good idea to shop now and then, especially if you are completely bare for the risk of earthquake, which is just a reality in our state. However, we did get through 2020 without a big quake, which a lot of us figured was the next kick we were going to get. Okay, tips to save money. We talked about raising your deductible, and you heard Carl mention that having a high deductible also has that extra benefit of preventing you from filing small claims, and that are going to cost you more down the road than you actually collected on the loss. And it's counterintuitive, and I think a lot of people feel like, hey, I'm paying for this insurance, by golly, I'm going to use it. But we're here to tell you, I'm here to tell you as a consumer advocate, that attitude is doesn't pencil out. It's really better to save your insurance for the really big ones, the big losses. Carl, when I say don't pay for more coverage than you need, contents and other structures, I've had this kind of frustration because I live in San Francisco. I don't have my garage is built in. I don't have any other structures, and yet in my policy, I'm paying for a chunk of other structures coverage, but my insurer says take it or leave it. That's how we do it. Is this, what would you advise? Is there anything there that you would advise a client? Don't pay for more coverage than you need.
Yeah, there are carriers now. The two areas that you see that the most are other structure and personal property in a big way. Personal property typically is calculated as a percentage of the dwelling. So if your dwelling is insured for $1 million, your carrier will give you usually $750,000 in personal property. I wish I had that kind of personal property. Most people don't. A lot of carriers now are finally starting to offer the ability to lower those limits. You can sometimes go as low as 25% for your personal property. So ask your agent or broker, say, look, I don't have that much personal property, or I don't have that anything else, other structure. My garage is attached. I don't have a pool. There's nothing out there but dirt, grass, or nothing. And if they're saying, well, this insurance company does not let us lower those limits, then ask them, say, well, I've heard other companies do. Which carrier do you have that will let me potentially lower those limits? Because there are carriers that are out there that will right now.
Yep. Yes. Good. So that's a really important tip to take away. In addition to something that I forgot to say, and I'm going to say it now. When you have that conversation with your agent, broker, or insurance company, where you ask all those questions about whether this policy's got enough coverage on the dwelling, or whether you should add rider for collection, or whether you can reduce your personal property contents coverage or other structures, whatever their answers are, you need to take notes. You need to save those notes in a safe place, so that if, God forbid, you have a loss and you find yourself underinsured, you have the evidence that you did everything that you could to be properly insured, and that you reasonably relied that the insurer was going to be doing what they told you they were going to do with your coverage. So we got a question. We've gotten some great questions. We've been answering them in the chat. Not all of them, but a few. Bundling. So this is really relevant more than ever these days. Usually when people talk about bundling, they're talking about buying your home and your auto with the same company, right? And a lot of the insurers that are multi-line, that sell both home and auto, of course they want you to do that. And so, the sort of the buzz out there in the big world is that you will save money if you bundle, but it has been my experience and my organization's experience that is not always true. But if your home insurance is with an admitted company that also insures cars, certainly you can see if there's a discount for moving your cars over. But it's relevant. This is relevant now because of the DIC situation, where where people, a captive agent, let's say I get my insurance through farmers, not to pick on farmers, but farmers is a big, they have a big share of the market in California, and they also are selling a DIC. So a farmer's agent, that's a captive agent. So you go to a farmer's agent and you say, can you please give me, can you give me a quote to insure my home? And the farmer's agent says, well, I cannot insure you through farmers, but I can put you with the fair plan, and I can sell you a difference in conditions policy, a DIC. Remember Carl's slide with the two puzzle pieces? You can see a farmer's
Amy is
agent.
my biggest fan. She loves my slides.
I do. So Carl, what, is a captive agent finding you the best option if they do this, if they say fair plan plus a farmer's DIC, or just offering you all they have to keep your business? And how can a person trust but verify that what a captive agent is telling them to do is in their best interest?
There's definitely a marketplace for captive agents. There's no question about it. And sometimes they have a product that fits right within the box, right? I mean, it's the right price, the right eligibility, it's the right coverage. Everything is exactly right. And if it fits in the box, then it's perfect. But the problem is that, to your point, there's no way to verify if that's your box or not, because you don't have anything else to compare it to. So if you're really, really comfortable with your captive agent, then, maybe still, check out online, go to a broker, get some competitive bids, and then give it to your existing agent. Not to be a jerk, but just be like, can you go over these with me just so I can be sure that what I have, is reasonable given what the market, is holding right now. It's not a jerky thing to do. We have clients that will come to us and they'll say, this is my coverage, or I'm getting quotes that look like this. I have people that come to us that have quotes from the same carriers that we do. That's fine. It's totally fine. Well, why does my quote look different than their quote? Well, because we're offering higher limits usually. So you got to be your own advocate and be comfortable to go to your agent or your rep and representative and say, look, I need to know, can you give me a list? Where else have you shopped my policy? If I go out and do some shopping because maybe contractually you can't, will you review it with me? If they say no, okay. I mean, I get it. I mean, I could see not liking that conversation if I were a captive agent. But, at the end of the day, especially right now, because there is such a large divide between the types of coverage that's available, you got to sometimes look out for, yourself, and just be sure that what you have it's not necessarily the best, but it's the best for you, because that's what it comes down to. A captive agent might have the best policy for you, but that doesn't mean that it's the best policy for everybody. So right. You need to do a little bit of checking around just to be sure that it's the right fit for you.
Yeah, that's great. So we are going to share these slides after with everybody who registered. Here's Carl's email address. You already saw his contact information. There are 3 agents up in NorCal that have also been very helpful to our organization during this crazy time, and all of their email addresses are there. We are still gathering information. United Policyholders has been conducting a survey now for a number of years, where we are trying to keep our finger on the pulse of what's going on out there. So if you have a minute, go to uphelp.org/California CA survey and fill it out. Tell us what's going on with you. Put in the time to research. Carl, coverage is available. You've heard it from Carl, not necessarily for the price that you want. And that, I don't mean to downplay that. I know that the cost of home insurance has become a really serious challenge for a lot of households in this state. So we take it very seriously, and we are really working hard to try to fix it. A couple of the questions that we didn't answer, we have time. We have about 14 more minutes here. So Mady asks, is there any advantage to staying with the same insurance company when you haven't filed a claim in many years? or does that clean record carry over to any new company? And Carl, before we answer that, I'll tell you, I saw I was looking at a policy today for an Oregon consumer, and it actually said clean record discount. So yeah, talk to us about this.
The answer is yes and yes. There's an advantage to being with the same insurance company for a long time. Look, the insurance policies are supposed to be very clean cut and very non-disputable, right? They are what they are. But as I'm sure you can imagine, that's not the case. There's gray areas all over the place. And if you're in a position where you're with an insurance company for a long, long time, the likelihood is, hopefully, that if you're in that gray area, they're going to look and say, wow, you know what? This person's been with us for a long, long time. We're going to err on the side of helping them out. We do that all the time with our clients anyway. And so yes, if there's not a specific reason to leave, then yeah, it's better to stay put. Having said that, your question of do you take your clean claim-free discounts with you? The answer is yes, you absolutely do. When you go to a new broker or a new insurance company in general, they're going to be looking at you as well as your house, for example, and they're going to look to see if you've had claims. So not having claims is a real advantage across the board.
Yeah, and one of the ways to see what all the insurers can see about you and your history if you are shopping is to get a free copy of what's called your Clue report, CLUE. That's it's basically like an insurance report, like a credit report. So you can get your credit report from TRW, you get your Clue report from the company that put that label. I can't even remember the name. Is it Choice Point or something? If you go to our uptohelp.org and you put in Clue in the search box, you'll get that information on how to get your Clue report and how to dispute any errors, because it is good to keep as much as possible. Obviously you can't help it if your house burns down, but it is good to keep a clean record, but also make sure that your Clue report is accurate. Let's see, we got, you emphasize the importance of verifying the financial stability of insurance companies apart from AM Best or the Leslie list. What is the most efficient way to do this? We do also on our website, we have 3 other entities that rate besides AM Best, Demotech and Best, I think. I'm sorry, I don't know. What's your answer, Carl? Do you say to your customers, I'll do it for you?
Yeah, I mean, to your point, I put in the chat, we can order Clue reports for people if they want. I put the link in the chat. It takes us all of 3 minutes. So if anybody wants it, the link's in the chat. Just click on it, put your info. We'll order the Clue report and send it to you. It's no big deal. But as far as how do we check, you can sort of get analysis paralysis if you start getting too crazy about this. I check AM Best, and that's enough.
I thought they were. I'm sorry, I'm looking. Somebody asked for something here. I'm just going to go back to that slide. Okay, yeah, the survey. Now I lost my train of thought. Where were we?
Clue reports.
Clue reports.
Oh, AM Best. AM Best.
I don't ever like United Policyholders to give information out that's not, of course, accurate and also user friendly. And so I actually went and I called the 4 names that we have on our website to try to check out an insurance company, and AM Best was the easiest. They have this toll-free number, and they said, we'll just cut through for you, but otherwise you do have to kind of be pretty tenacious. It's hard.
Plus, again, they're all going to give you the same information. They're all going to give you how many million or how many billion they have, give or take, and a letter grade or some type of scale. You're not going to find a massive discrepancy where one financial rating company says they're 2 billion plus and the other one says no, they're 500 million only. So checking one is really sufficient.
Okay. How would you recommend that one approach a carrier who inspects your house and comes up with a per square foot replacement cost which you consider too low? Well, that's a great question, and that happened to me. I try to practice what I preach, and I had I called my insurance company and said, hey, could you send somebody out and take a look at my house and tell me if I'm insured properly, insured to value? Because, in the course of my work, I talk with a lot of heartbroken people, who don't have enough insurance, and I would love to not be one of them. And so they, at first they said, well, we only send somebody out for, if your home is over $1 million. I'm like, well, okay. And they said, but, we will, because you're asking. Okay. So they sent the person out, and the person did a report. And I thought it was kind of low. I frankly, and frankly, I, from other work that we do, we know that a lot of insurers are using software that comes up with a good enough, dwelling replacement calculator, good enough to close the sale and, sell the policy and move on. And the person will never know that they're underinsured, unless, you have a total loss. And then but all I did was call the insurance company and say, I'd like you to adjust my coverage A up a little bit, 50,000, I think it was. And they said, okay, are you sure? And I said, yeah, I'm definitely sure. And that's all it took. So anything else on that, Carl?
Yeah, that we run into that on occasion, and the issue is, like you said, you need to just tell them that's not enough and raise it. I promise you, they will not have a problem raising your coverage and taking more money from you. They will have no problem with that at all. But yeah, and Amy sees this all the time because people are coming to her organization for help. People are grossly underinsured as a whole, and that is primarily the fault of all of us, because on the one hand, people are smart enough to know that the more coverage they have, the more money it costs, and they want to save money. And in the insurance carriers, right, they want to get as much business as they can. So I've never found one estimator from any insurance company, and mind you, they all have their own flavor of the month for what estimator to use to value what to replace, the replacement cost amount is. I've never liked any of them. None of them have been accurate. Every few years they increase the limits. It's worthless. You need to go based on like that slide that Amy showed you. Take a conservative approach to the dollars per square foot. Call a contractor. Say, I'm curious. Come look at my house. Pay him $100. Say, I'll pay you $100. Come look at my house. Tell me what you think it would cost to rebuild this house. It's totally worth it. And hand that over to your insurance company or to your agent and say, I want it insured for this. I don't care what your little estimator says that asks me what percentage carpet do I have in my house versus tile. What is that really telling you? Nothing.
Right. I mean, this is a whole fight unto itself. Our organization we've been trying to solve this problem for a long time. And I think I'm not going to call it a standoff. I'm going to say that the insurers generally are gambling that you're not going to have a total loss, because it is relatively rare, so that you're never going to know that you're underinsured, but it's a price that they think you're going to pay. And it's look, let's be real. Those of us who live in California and have sort of a hyper awareness of risk know how important it is to pay a little attention to your insurance. But most people don't pay attention to their insurance, and they just blindly trust. And they also shop on price. Most people, unless they've been in an area where there's been a wildfire, generally they think of it like everything else. The person who wants to sell me the policy probably wants to sell me more than I need, because they're on commission. And so people think, well, if the agent tells me I should buy more, he's just trying to make more money off of me. And we know that in many cases that's not true, because we've spent so much time with people who didn't have enough insurance. And we also know that people, of course, you want to get the cheapest premium. No one's looking forward to spending more money on insurance than they have to. It's not like you get any pleasure out of it. Okay, a couple more good questions. We got a lot of great questions. We're not going to be able to get to all of them, but most of them. So question about how to assess if your home is retrofitted, secured to bedrock, etc. So Carl, you've had earthquakes down in your area. Up here in the Bay Area, a big one, as a matter of fact, sent the insurers running from covering earthquakes after Northridge. I just have no idea how to find that information or who to hire to determine that info of whether or not your house is on bedrock.
Yeah, I'll answer you in a way you really are going to not like to hear. It doesn't matter. We sort of have a joke in the office is when someone gets it, when we say, we're going to offer you earthquake insurance as well. And people they used to say, oh, I don't need that. I'm on bedrock. It doesn't matter. It literally does not matter. To Amy's point, during the Northridge earthquake, there were homes, plenty of them on bedrock, and they fell. It doesn't make a difference. There are certain areas that are known to be worse, certain homes that are built on what used to be liquefaction areas. We know those are really, really bad. But other than that, there is no such thing as a particular type of foundation that is just okay, and you're no longer at a risk for earthquake insurance. Even bolting, I've had people say, well, I'll just get my home bolted, and then I don't need earthquake insurance. The problem with that is bolting is excellent for the types of earthquake that are up and down, but for earthquakes that move side to side, bolting is actually worse for the homes. So there's really no magic way to know if your home is going to be affected by an earthquake or not. There were homes in Santa Monica after the Northridge earthquake, not exaggerating, on the same street. And you could see this house was, demolished. The next door neighbor, not a broken window. And then the house next to it, demolished. And then 2 houses down, a broken window. It is the way the earthquake waves move through the ground is just, it's not something that they can predict with any level of certainty. So, unfortunately in California, we have earthquakes. So it really is one of those things. I love your expression about if you don't get earthquake insurance, you just have 100% deductible. That's sounds like something a salesperson would come up with. I love that.
Well,
but it's true.
I mean, I'm a risk nerd after all these years,
Right.
United Policyholders cannot help people if they don't have insurance. And we fought really hard to prevent the earthquake coverage from getting broken out of the home policy, because we knew that as soon as that happened, a lot of people would just say, well, I'm dropping it, and that would be it. And that's the reality. And I get it. I mean, am I enthusiastic about telling people to lay down another $2,000 a year? No. But your home is for most people your biggest asset. So our message around it is just at least get a quote or two and make an informed decision, and don't go on rumors, oh, my neighbor says it's a ripoff, and so I'm not going to buy it, or that kind of thing. I mean, it's definitely a personal choice. I know people who are in the insurance business who don't have it. And it's a personal choice, and we just encourage you to make it based on information. So we are out of time. I want to thank Carl Sussman for being the insurance agent with the best sense of humor.
It's a low bar, I'll tell you that.
I'm sure you're right there. And for being, willing to kind of, go back and forth with me, because, a lot of the people in the insurance industry, they think, oh, United Policyholders, consumer advocates, they just hate insurance companies. It's like obviously not the case at all. We think insurance is a great product when it works. We want it to work for you, and we are here to give you the best information that we can to help you make good decisions about protecting your assets, not pay more than you need to, but not pay less than you need to in order to really protect your assets. So Carl, thank you for your time.
Thanks for having me, Amy.
Yeah, thanks so much. And my team, Val Brown helping out with the questions, and Carolyn Winter having helped with the registrations, and all of you who took the time to be with us today. Thank you. Good luck. And please do access our website and stay in touch with us so we can be as helpful to you as possible. So good evening. Thank you. Signing off.
Thanks, everybody.